Hello and welcome back to Stock Market Weekly. I'm your host, Evan Medeiros. This is the show where we break down the notable moves across financial markets through the lens of technical analysis. We're publishing every Friday. Today's Thursday because of the long weekend. But make sure you are subscribed to our YouTube channel. Hit those notifications so you never miss an episode, so you're always prepared for the trading week ahead. Let's get right into it. Short week out there, long weekend. I think we all deserve it after such turmoil across the stock market. But this week there was less turmoil. Things cooled down, and I'd say that was a general net positive. The fact that ranges compressed a little bit, stocks kind of slugged it sideways. Maybe we ended negative, but I think the compression is ultimately a good thing. Now, a couple of the takeaways and highlights from this week was Federal Reserve Chair Jerome Powell was out on another presser this week, basically digging his heels in, saying that the Fed has time to be patient, to not act, to resist the urge to cut interest rates prematurely. The markets, of course, don't love that. Of course, President Trump does not love that the Fed is not really coming to the rescue so soon. But that is something I think we need to really test on a worsening of financial conditions to see when and if they would step in. NVIDIA took a hit this week, so export controls showing up about a $5 billion impact to sales, which is pretty significant, and the stock certainly acted in kind. United Health had a huge move as well. That on, I think, just rising medical costs. I didn't get the full story there, but interestingly, the healthcare ETF was sort of balanced out by Eli Lilly making a huge move on some drug progress. So some large movers this week from some very big companies. Earnings season is hitting up, and Netflix, I believe, is reporting as I speak, so we can take a quick peek at that chart a little bit later. And the VIX is back down to about 30, so I would say, again, some compression, some of the wild swings have been kind of worked off, and stock market breadth was okay this week, so we're going to look at all of those things. Before we get into the charts, though, our sponsor is Investors Business Daily. Thanks to them. Shout out to them. We've got links in the description of this episode. Sign up for their market surge, and they are hosting a tutorial webinar free this weekend on how to use it, the basics, how to get the most out of it. I'll be on there learning as well, just to kind of fine tune my understanding of the platform. So check out Market Surge. We've got a referral link in the description, and then you can get their webinar this weekend. And with that, let's get into the show. All right, here we go. We've got some charts in front of us. Wharton TC 2000. We love Investors Business Daily. We love Market Surge. We love Wharton TC 2000. We support all of these platforms, but Wharton TC 2000, that's what we're using in this video. We've got links in the description for lots of the layout screens, indicators that you see throughout this presentation. Let's get right into it here. You can see 1 week change was negative across the board minus Russell 2000. So the Russell 2000 was up 1.2%. That's actually notable there because that is going to be one of the small takeaway themes from this week, is that breadth did improve. Heavyweights were sold off, large cap tech, but the average run-of-the-mill stock, let's call it, was higher this week, or at least tried to be higher this week. If we take a look at volatility, this is one of the things that we love to see here, is VIX coming down, right? NASDAQ vol coming down, Dow vol coming down. So the VIX less than 30 going into the weekend. I'd say that's a pretty big win. I wouldn't be surprised to see a floor not too far below where we currently are. If we close next week below 25, I'd be pretty surprised. I think we're just in a higher elevated volatility environment for the time being. If we take a look at sectors here again, kind of a split race, speaks to the market breadth considering 3 of the 4 major indices were down this week. You would be, maybe a little bit surprised to see 5 of the sectors here were in the green. 4% higher for real estate. That was notable. Energy up sharply, utilities up as well. Technology was the hardest hit to the downside. If we take a look at our sector trends here, this is a custom indicator, smart trend filter indicator. It's available for TC2000 and TradingView users on our website. You can see we did get a couple of green prints here. So top right, real estate, XLRE, you can see finally making the turn up after being in a bearish positioning here since the beginning of March, has finally turned the corner on Wednesday, printing a green dot there, showing us that bulls are stepping in. Same with utilities. You can see earlier in the week, this turned the corner and started printing green, and with staples. Now, of course, staples, utilities, that is a defensive tone to the market, full stop. But needless to say, you know, we are getting some things that are stabilizing again and starting to turn up. That is, again, one of the silver lining themes from this week's episode, I think, is that compression and working off the wild swings from the last few weeks is starting to take place. Now, if we take a look at our market breadth slide, there's really not too much to say here in terms of 52-week highs and lows. We're still kind of in the middle ground, no man's land, so to speak. We're not getting stocks hitting 52-week lows. We're not really getting stocks hitting 52-week highs. So it's kind of a dry spell right now. Again, we're going to need to go sideways, slog it out, and wait to see this market make a more meaningful move up or back down towards those lows. That's what's going to get this indicator starting to move again. If you look here on the right-hand side, again, if we look at the average stock, so these dials on the right are showing the percentage of stocks that closed up or down on the respective indices. And again, you can see S&P 500, for instance, was firmly in the red for performance this week, but 58% of stocks actually closed in the green. So that's showing you, again, average stocks closing up, large cap stocks bringing that index weight down. Now, let's take a quick look here at our macro slide. You can see that the dollar index is still sliding, so it didn't get a tremendous amount of stabilization there for the Dixie. You can see still just kind of selling off, oversold conditions for sure. Easing conditions is what that does suggest and show for future perhaps, but right now we're still seeing the dollar under pressure. Fortunately, that Treasury yields did cool off a little bit. You know, we were flirting with 4.5%, which is getting to pretty dangerous territory. I think we closed 4.3, if I'm not mistaken. I forget what the true 10-year yield was, but down from last week, which is good. That's what we wanted. That was one of our biggest risk factors we talked about last week, was if the yield on the 10-year continued to just see a momentum push up, we've got problems in this market still. So that was nice to see. And commodity land loved the continued weakening dollar here, and a nice rebound in oil, copper, gold continues to just rip to the upside, Bitcoin and silver. So let's get into our charts. Started off with the S&P 500. You can see that the range from this week, just a weekly bar, quick high-level perspective looking at the price action. This range certainly looking a heck of a lot smaller than the prior 2 weeks. Again, that's a good thing in my books. We want to see things cool off a little bit. We want to see those wild swings kind of dissipate. If we go down to a daily chart here, you can see that we spent the week, we tried to push up on Monday, and then we kind of chopped sideways, failed, and then we kind of moved into this 2 inside day print here, right? So we had, short week. So Wednesday and Thursday, and Monday, Tuesday in here. So we kind of ended the week with an inside session here. It looks a little bit ominous. It doesn't look like there's a tremendous amount of strength, but I'd say that on equal parts, I don't know that the sellers have a tremendous amount more that they can press on either without further catalysts. I think we're just in a headline-driven market right now. We're really kind of looking at all of these headlines coming out of the White House on negotiations between the U.S. and Japan, and the U.S. and Germany, the U.S. and Italy and China, and pricing in all of this and swinging the market back and forth as we get positive or negative news, depending on how those trade deals are coming to terms. We also have earnings season now, which is really going to heat up next week with some of the bigger heavyweights, and the market is going to start to look at what kind of clarity we can get from companies, even though, like we talked about last week, it seems like most of them have a pass right now on future guidance, especially with the uncertainty of trade right now. So S&P 500, when we look at levels, this is still a trader's market right now. I think doing less absolutely makes sense. I think this is a great environment for day traders and these short-term traders that can really take advantage of price swings and higher volatility levels. It's a good playground for those folks. But for the intermediate term and the short-term, medium-term swing trading, it's very easy to get chopped up right now. So just be a little bit cautious there. In terms of levels, 54.50, 54.60 is definitely proving itself as your top resistance area here. We've kind of beaten our head against it one time, two time, kind of three times here, and the market has just brought in sellers up around 54.60. So if something changes next week, if we can start to get progress, a breakout, some expansion over 54.60, then that tells you there's probably another push coming here, maybe fill this gap that we talked about last week in the S&P 500, which happens all the way up to 56.30, and then you kind of fall back into this range here. It would be pretty surprising to me, really, in either direction, to be honest. I could make a good case that a sustained rally from here up north of, I think we could push up to here to fill this gap. I think we could get as high as 5650, 5700 and still kind of a trader's mindset and still have these tariffs lingering. But for a real sustained move over 5700, I think you're really going to have to get a lot of that trade uncertainty behind us. We're going to need deals made. We're going to need the market to not have to worry about that. And while that's still on the table in this 90-day or 88-day window that's left, I think things are just going to be choppy and tough to really sustain. On the flip side, to be a seller here, and looking for that extra catalyst here, it's tricky unless you really see things start to erupt with Japan or China in terms of trade negotiations. Or like we talked about last week, if the 10-year Treasury yield just starts to continue to get unhinged and starts to go parabolic, but that situation seems to be handled, at least for now. So it really is going to be, again, this headline kind of moves of tariffs, I would imagine, in terms of how we're going to swing here. Price structure looks just messy generally here. It looks choppy. It looks messy. I think if we can, hang on to this inside day that we printed, if we can hang on to this level right in here around 52.20, and we can turn this into a higher low and push up, I think, again, you've got a good shot at kind of filling this gap and kind of coming back into this old range, which was right when the tariff frenzy really started. And if we start losing 5,200 and gathering some steam, then you have to start to look at these lows here. So right now, trend is still lower on the medium term. It's a messy environment. It's a headline driven market. We're going into earnings season. Doing less is probably going to be the best results for most. And if you're capable of navigating the 30 plus volatility environments, then there's obviously opportunity for you. If we take a look here at the NASDAQ 100, you really have similar price action this week. We had a larger range on Monday, inside day Tuesday, broke down on Wednesday, inside day on Thursday. So we're kind of set up with a very similar situation. The Qs have some pretty stiff resistance around 465 or so. And if we can hold over 438, then at least, we could try and stabilize and compress and put in a higher low. If we roll over hard from this 438 area, then all bets are off. It gets much more dicey as traders would start to look at these recent lows. So that's kind of the way things are. Sentiment still looks pretty mixed out there, but mostly pessimistic in this environment, which makes sense. But that is what's creating the opportunity, and liquidity is pretty light right now. So again, these moves can happen pretty quick. So that's kind of the lay of the land here in terms of the major markets. I'd say messy overall, and you certainly need to know your levels and be willing to deal with volatility and quick moves if you're going to be participating. If we talk about the VIX here, like we said, it's down to less than 30. That's a great spot. It's a good win, I think, for the bulls this week. If it can stay down here anywhere near or in between 25 and 30, I'd say that's a great win right now for the market, and that could even allow us to chop around and even grind up a little bit. But I would be surprised to see the VIX back down for less than 25. I would be and I would think north of 40, we have another issue or catalyst or some extension of the turmoil, let's call it. So VIX around 29 kind of makes sense. Gold here continues to go parabolic. I mean, this is basically every money manager's answer right now in terms of where they want to put money, rotate capital. It's GLD. It's not the dollar, because the dollar you're continuing to see flight away from. Treasury yields did stabilize this week. Equity's kind of stabilizing, but it's really just gold continues to go parabolic here. Again, it's a really tough chase. I can't make much compelling reasons to want to jump in now if you have not been involved. There are potentially opportunities on gold miners, individual gold miners in this space. They continue to show up relentlessly on my momentum scans, breakout scans, as gold miners just dominating the list. Again, you got to just know and be able to manage that trade and momentum and learn how to, know how to get off the wagon when that trend starts to turn. But GDX here, I mean, arguably, and some individual companies in here could still be offering up decent opportunities. Now, if we take a look at Treasury yields, IEF, again, this is the bond fund. You can see was up marginally, or up reasonably this week, not marginally, but pretty reasonably. 10-year Treasury yield index, again, coming off a little bit from last week's spike. It's good that momentum did not continue. Panic did not continue. Dislocation did not continue. So that was nice to see. Let's take a quick look at Bitcoin here, which again, it continues to look increasingly resilient in this market environment. We're back above, 80K, 81K. This is really the area I want to see Bitcoin stay above, is this 81,000 area, 80,500, right in here. There's just a lot of wicks and support and shelves of, dip buyers coming in around that area. We're basing around 85. We spent the entire week basically going pretty tight sideways nowhere. We had a nice move up to start the week, and then we've just been chugging sideways between 83 and 85. So this is getting primed and coiled for a move. The question you're going to ask yourself here is, are we moving to the 90K target? Are we going back up towards 90? Or are we rolling back over towards these lows? If we take a look at IBIT again this week, you can see on the weekly, it was up 1.24%, pretty tight range. Again, doji here, indecision, compression, vol expansions likely coming here for Bitcoin. So place your bets. I do have, again, exposure in this space once again. And I think the relative strength has been notable, but we need to see more proof and breakout action to really get that needle moving. So that is Bitcoin. I think it's interesting. I am long. Our trend following system is not long yet. It is still sidelined and parked, waiting for its signals. If we go to NVIDIA to take a quick look at this price action. Yeah, so this one, again, down 7% Wednesday as the news broke, I think, after hours on Tuesday about the $5 billion charge. The chart here, just slugging sideways, kind of chopping it out, digesting. I mean, again, you could say that it's a company that is growing into its earning multiple and sales appreciation over these past multiple years. I know a lot of fundamental analysis on this would cite that this company is still trading pretty cheap, but it's at the epicenter of just lots of cross currents right now. And so whether or not the company is cheap almost doesn't matter. It's about sentiment. It's about the immediate, trade wars that are going on, and its liquidity in the stock market. It's a massive company and it's dominating, just lots of different indices. So NVIDIA right now, I mean, it's just choppy sideways, messy, but it doesn't look terrible if it can stay above, call it $99, $100. It is pretty well off of its lows here from Monday, despite this recent move down. UNH got clobbered here again on Thursday, 23%. I think it's one of the largest moves down. So this one here, again, was starting to break out, was starting to show some nice relative strength, but it's back to a multi-year low here, back to the bottom end of its range. But like we mentioned, Eli Lilly here making an equally impressive move on Thursday, kind of balancing out the healthcare space, up 14%, big volume, moving to the top of its range. So basically trading moving places there for UNH and Eli Lilly. Last but not least, we'll take a quick look at Netflix here. Let's see if I can get a pulse on where the heck this thing is trading right now. I can't. I don't know why my chart's not updating, but did report earnings, and don't think I'll be able to get the reaction right now. But going into the numbers here, well, it certainly was, one of the better looking of the big companies. Obviously, Netflix really not going to be capital intensive business affected by tariffs like an Apple, right? Of course, right? So Netflix is actually one of the charts I shared on social recently. Same with Spotify. They both look pretty similar, and both kind of streaming tech plays that have decent growth but aren't affected by tariffs, and capital is finding their way to it. So that is it. That is what I got for this week. Short week out there. Hopefully you were enjoying the slightly less chaos that the markets dealt out this week. Again, check out the links in the description of this show. Our sponsor, IBD, they've got a webinar going on this weekend. And again, our trading systems, our TC2000 tools, some of the other services that we offer at the Trade Risk. If you're in need of some assistance, reach out to us. Let us know if we can help. And with that, thank you so much for tuning in. It's been another episode of Stock Market Weekly, and we'll see you back here next Friday. Take care.